Hello and welcome. My name's Kristina Burwood-Ansell and I'm Product Director for Collections and Tracing at Experian UK and Ireland. I'm joined today by Colin Brown, CEO at Aryza Group, and we've joined in partnership to talk to you about supporting your customers through financial hardship and the pandemic. So here at Experian, we use data to create opportunities and understanding for your organisations, your consumers, and also for society. And with Aryza, they're an experienced developer of tried and tested software for the financial services and insolvency industry. And together in partnership, we're helping you understand your customers during this time. So we've heard all too often that the pandemic is presenting us with unprecedented challenges, and this is true for organisations and consumers alike. There's been huge spikes in demand as consumers are seeking financial help and calling in to organisations to seek support. There's reduced staffing levels affecting these organisations due to those who have unfortunately fallen ill, and call centres are facing limited capacity due to social distancing and having to move people to a working from home environment. The impact back at home to these consumers is also very severe. We're seeing huge rises in unemployment, more than we've seen before, and the employees being furloughed has caused a loss in income in the short term. This loss in income and the changes in these circumstances are causing household debt to rise, and consumers are seeking out new ways to borrow money and to understand their financial position. Building on from this, you can see some stats here that bring it really to life. So in July, between 6 and 20% of consumers were on payment holidays, 1 million of those with credit cards and 700,000 of those with loans. Almost 10 million people were on furlough in August. And over 17 million UK workers are currently at risk of unemployment, and that's on top of the current rates of unemployment. Over a third of us have also seen a decrease in household income in the period of March to June. It's been well documented in the press in April that claims for universal credit are in excess of 2 million now. We're seeing increased use of consumers using their unauthorised overdrafts or looking for new forms of credit in terms of high-cost short-term loans. Over a third of households have additional arrears as a direct result, and we're seeing an average debt increase of £1,000 per household as a direct result of COVID-19. We are unfortunately, towards the end of this year, also seeing huge rises in collections volumes across our clients. So what does this mean for you? Ultimately, more customers than ever need help, and the new types of customers too. So you've got the customers who maybe needed financial support before, but now they perhaps need a bit more. Maybe their circumstances have worsened, or maybe they haven't changed. But you'll see new people who have come into unprecedented changes and are seeking support to understand how you can help them. You need to understand not just financial vulnerabilities, but non-financial ones too, and how this is affecting your customers during the pandemic. Ultimately, there is more debt and more fraud. And where there's more debt, you need to understand the changes in your customer's situation. How has their income changed? How has their expenditure changed? And are they still able to meet their financial commitments to you at this time? With all this pressure on your staff and systems, you need to be agile in your response, and you need to be able to adapt to this huge volume and change, and perhaps automate some of these calls and conversations that are coming into you. You need to have the MI in place to understand how your risk profile is changing as the circumstances of your customers change throughout. So I said earlier that we've partnered with Aryza, and what we're doing is bringing Experian's data and Aryza's software together to help you protect your customers and your business. I'm going to introduce Colin now, who's going to talk you through how we can help. Over to you, Colin.
Thanks, Kristina. So we know now that overnight, back in March, the market changed, and businesses were facing increased levels of customer vulnerability that they'd never experienced before. And consumers' anxiety levels had also increased as they faced a real threat to not only their lives, but also their livelihood. And businesses had to adapt to ensure they maintained and complied with the true spirit of treating the customer fairly. But how could they do that with these increased volumes, with these work from home conditions and all the other obstacles that the pandemic put in front of them? What was needed was an automated but personalised response. So together with Experian, we wanted to change the conversation and have a new conversation with consumers. So instead of that traditional conversation of chasing debt, we wanted to have a conversation where businesses were seen to support and help consumers through what are unprecedented times. So using the power of open banking and the credit bureau searches, we are able to offer personalised options based on an individual's specific circumstances. And additionally, we can offer other options such as utility switching and benefit checking. So that relationship that consumer has with that business is much more enhanced and a much more trusted relationship. So some of the benefits that the platform will give to you and your consumers. Well, we know the FCA came out and released some guidelines on how to support your consumers during COVID-19. So we developed and designed the platform so that it complied with those guidance. There's a significant reduction in operational expenditure with the ability to automate kind of payment plans. We're able to offer streamlined and bespoke customer options as discussed, but also we can do that with a platform that's made to look and feel like your brand. The platform supports both SMS and email contact strategies so that this reduces the pressures on your contact centres. What's really exciting about this is the speed at which this journey can be delivered. On average, it takes about 5 minutes to assess a person's income and expenditure, do the credit bureau searches, analyse all that and present those personalised options. Now, can you imagine doing the same thing with an agent over the phone manually? It would take upwards to 30 minutes and beyond, and you would never achieve the level of accuracy. And underlying all that is a rules engine that presents those options, and that rules engine can be configured to align with your business rules. So we're getting some great feedback from some of the businesses and organisations that we're currently working with, and you can see a really nice comment there from Stephen Hunt, the CEO of BNP Paribas. One of the proudest things in the BNP project we have is the speed at which we were able to implement. On the 20th of May, we got wind of an opportunity in BNP. On the 26th of May, we demoed to BNP. On the 28th of May, we got the green light from BNP. And on the 27th of June, we were live in BNP. So what that demonstrates was the responsiveness and reactiveness of Experian, BNP, and Aryza to what was an overnight market change. So I'll hand you back to Kristina.
Thank you, Colin. So by way of a quick summary, we've spoken to you about data insight and how it has the power to protect your organisation and your consumers, especially in times of change. Trends are indicative risks of things that require your attention, and it's around being proactive with your consumers and understanding ahead of the game their changes in circumstance and how you can proactively support them. We just heard from Colin how automation will allow you to act quickly and cope with increased call centre volume, reducing those overheads by 80% through digital and opening up that other channel to your consumers. Offering self-serve doesn't just give a new digital channel, but it gives a personalised experience to your consumers, which will empower them and help it streamline your processes as well. Most importantly, we can help you understand your portfolio and position, not just now, but as it changes and as these risks emerge. Thank you very much.
So I'm back in the studio with Kristina and Colin on the line to take your questions. We've got quite a few coming through, about 6 or 7, so plenty of time that we've got for Q&As. So a few here are kind of market observations, I guess, in terms of observations on how lenders' behaviour is changing and what volumes, I guess, they're seeing at the moment. You've talked a bit there about volumes seeking help, including universal credit. But in terms of seeing a spike in demand from customers for financial support or forbearance now, does it seem to the both of you that that spike in customer demand and queries for support is coming right now, or do you see it potentially amongst clients coming into next year?
So I'll answer first, and good morning, and thank you, Marcel. What we're seeing at the moment is a lot of support needed for payment holidays. And you've got our clients having to deal with the increased calls and volumes that are coming in, extensions to payment holidays. What we're expecting to see later on and further through this lockdown is more of the same. And then, unfortunately, we will see people struggling to make payments once the payment holidays end. So we are anticipating that to ramp up in the next quarter, really, after this next lockdown. But we are seeing a large volume of payment holiday requests coming through.
Okay, and Colin, what's your observations on the extent to which, I guess, clients are seeing that large spike, I guess, that would have been expected around October, November?
Yeah, well, I think what we're seeing kind of from the insolvency side of our business is that the numbers looking for debt advice at the moment has actually gone down, and that's to a large extent the extension of the forbearance and the furlough schemes that the government are providing. But we do anticipate that probably early next year that there will be a lot more consumers struggling with their finances, and we'll look to see for debt advice. So acting now in terms of helping and supporting those customers, I think is critical for the lending sector.
And I guess just a supplementary question to that, Colin, generally the personal and corporate insolvency statistics, there hasn't been a big increase, and it's probably due to the same primary reasons, really, the extent of support, the restrictions on chasing, I guess, companies and individuals for debts of various types. Is it even possible to kind of see that curve beginning to increase in January, February, March at all? And I'm talking the actual insolvency figures.
Yeah, well, I think what would be reasonable to expect is that once the kind of government schemes stop, that then there's going to be a lot more both consumers and corporates facing difficult times. I think the schemes at the moment are probably delaying the inevitable for both consumers and corporates. And look, hopefully that's not the case, but we've got to face up to the facts that right now there's a real threat to people's livelihoods with COVID, in particular in certain kind of industries and sectors.
Of course, and payment holidays comes up actually in one of the questions too. I guess because the FCA only just a few days ago issued the new guidance for payment holiday extensions and a much longer window that customers can apply for them if they haven't applied for one so far. And I guess this presents equally a challenge to credit reference agencies as much as all other regulated lenders because of the need to respond so quickly. So perhaps, Kristina, you could talk about the general challenges for a credit reference agency, as someone has asked, in responding to these guidance updates on payment deferrals, because again, the credit reference agencies will have to help protect the credit information of individuals who are yet to take a payment holiday.
Absolutely, yes. So we actually, across the credit reference agencies, have an agreement to treat them the same way. And the guidance is available. If anybody wants it, we will openly share it with you. But essentially, we do have to take the information in and make sure that we don't adversely affect anybody's credit rating as a direct result of taking a payment holiday. So that is exactly what we're doing at Experian. We are not affecting people's credit ratings by the fact they're on a payment holiday. And then in terms of the products and services, I mean, you saw on the presentation, it's around really helping our clients understand. They will know when people have requested a payment holiday and how can they go about supporting them. What data can we give them that allows them to understand their financial situation better during this time?
Okay, and I've got a couple more specifics here on open banking, actually. So, I mean, it's come up a few times this morning, and I guess this could be either one of you. So someone has asked, what is the typical split you see between those that use open banking versus those that choose to enter their details manually? Anyone would like to take that first?
Yeah, I can take that. And what we're seeing at the moment, that the typical split will be 40% of kind of consumers going through the Aryza Recover product are using open banking to fill in the income and expenditure, with 60% using manual entry. So we're quite pleased with that. We know that open banking is, relatively in its infancy in terms of usage, certainly not in its infancy in terms of the technology, but in terms of its usage, I think it's reasonable to say that it's fairly new. And as people get more and more used to completing open banking on digital journeys, we fully expect that kind of percentage to only go up.
Okay, same question to you, Kristina. I mean, there's probably quite a few questions here about open banking. I mean, ask the same one about the typical split you see between those that use open banking versus those that choose to enter their details manually.
Yeah, I mean, I concur with Colin. We, within the platform of the several clients we have live, that is the typical split we see. It does steadily increase as well. So we do work with clients to kind of give the education piece around open banking and how consumers can then therefore understand that it's actually to help them by consenting this data. It helps them be on a more appropriate plan that they can actually afford. And it is really in the customer's benefit. And I do agree. I think we will see these rates increase. But yeah, at the moment, I would say it's about 40-60 split, 40% through open banking, 60% manually. And I guess that's a really key feature of the platform, that we can allow the manual input as well, so that people don't drop out of the journey and they can get that assistance.
One other issue that comes up whenever we talk about open banking at these events is how you convince consumers about the give and the get, the value of offering their consent for the data to be shared. But I guess you'd expect some kind of acceleration of open banking over the last few months, since I guess maybe late March, so that lenders can ascertain the very kind of timeliness and up-to-date situation of their customers. But on just one question on that, Kristina, is have you kind of observed any really good strategies or effective strategies where consumers have been convinced successfully of what they'll get out of giving that consent to share that data?
Yeah, absolutely. I mean, I'll defer to Colin on specifics because he's definitely got more in the client-facing side. But we have been working with exactly what I just mentioned, the education piece, the words on the page, really making it simple for the customer to digest as they're in these platforms and see straight away, actually, when I consent my data, it's not because they're trying to take every ounce of spare money off me. It's to make sure that I can actually realistically afford the payment, or I can't afford it and I need a payment holiday extended. And actually, I therefore won't continue to miss these payments because it's far more realistic that I pay £10 a month than £50 a month. And it's around really letting them know that it is actually to support them rather than take every last penny of their disposable income.
And
yeah,
Colin, your view on where it's been done successfully, I guess, of consumers being convinced of the inherent value of and the opportunities it opens up for them of sharing their data and giving consent?
Yeah, I think the key is trust, and consumers having trust that their information will be used correctly, and that going back to that really key point of kind of supporting and helping the consumers, and that piece that we said in the presentation about kind of changing the conversation to supporting and helping. Never before has the requirement or need now to support. As much to support your consumers. So being able to show them, different options that are kind of personalised to their particular circumstances. They've offered them, the ability to a click of a button, check their benefits, check if they got the best kind of savings in terms of bills, monthly bills, etc. I think that's going that extra mile that you could never achieve. Well, not that you could never, but it would certainly take a long time if you kind of manually gone through someone's data. I mean, the real power we have now with this data really allows us to really help consumers and kind of maintain that whole spirit of treating the customer fairly. So to me, it's the trust and it's the help and support. If you're providing that, I think the consumers are likely then to engage in the open banking journey.
Yeah, you mentioned something about the personalisation, I guess, of the experience for consumers. This seems as important on the collection side coming up, I think, because the FCA guidance that came out before Sunday and Monday, before the lockdown was announced, was about the need for tailored support and personalised support for customers when they're coming to the end of payment holidays. You would kind of assume from that they would explore perhaps open banking in order to personalise, I guess, the forbearance treatment for customers. So have either of you seen either the FCA guidance as a catalyst or anything else being the kind of the change mechanism that has, I guess, prompted banks to look much more at open banking in the collection space than they wouldn't maybe not have done before?
So I think it certainly encouraged more people to consider open banking without a shadow of a doubt. Personalisation has become forefront of everyone's mind across the whole customer life cycle, to be totally honest. But what I would say actually is in collections, we have seen this already. We do see our clients really wanting to personalise the journey, and that's not just because it has better contact rates, better less dropout rates with their customers, but also it helps the clients too. And if you can really personalise a payment plan or whatever is the right treatment for that person in hardship and unfortunately heading towards collections, it's less of a exposure risk to you as our clients as well. There is less chance that in 3 months' time they are going to drop off their payment plan because it wasn't appropriate, or even not make that payment in the first place. So there were already massive benefits to tailoring plans, and I do think open banking has helped. I do think the FCA has, helped give that a bit of a kick, but we have seen clients already exploring those options.
And Colin, just a supplementary question on that. I guess the ability to personalise repayment plans should, in theory, I guess, enable those to be more sustainable over a longer term, because I guess so many lenders right now, or they could be about to be working through some manageable, sustainable repayment plans for the longer term. Presumably, open banking has a key role there in making sure those are sustainable in such a kind of period of uncertainty, turmoil for lots of different customers.
Yeah, well, I think it comes down to the accuracy of the data you get from the open banking versus if you are on a call to a consumer requesting the same information. A lot of the time, people may forget, certain expenditure item that they have, because you've just called them looking to get them kind of back on track, etc. They're under pressure. They're not sure of all their kind of monthly outgoings. So I think the accuracy the open banking gives you will mean that that personalised piece, is to their specific circumstances. I think that to me is the key, and the ability to do that, in minutes rather than hours, is also really key. So you can give kind of instant, options back to consumer, but based on really accurate data, and that's what makes it more sustainable. That's what makes the ability for the consumer to kind of stay on track, because you're actually getting your kind of a live banking feed from that customer, as opposed to sometimes finger in the air kind of answers where they're trying to remember, well, how much do I spend on this, how much do I spend on that. It is the accuracy of the data that makes it much more sustainable.
And just one last question on this for you, Kristina. There might be many lenders exploring and considering an open banking solution right now, an open banking provider, and we would be wondering about how to test the accuracy of the data and how that's engineered. So, if lenders are exploring that right now, what kind of questions do you think would be wise and practical for them to ask of a potential new provider?
I think you want to understand their categorization engines as well as the open banking data itself. Are they just going to be taking a raw open banking data feed? And if they are, what are they going to do with that data? It is a significant amount of transaction data that comes through. So are they going to look at taking a categorization engine as well to understand it? I guess also what they want to understand is if they're going to take an off-the-shelf product, such as one of ours, integration. What's the integration headache for them? Can it be minimal? I mean, we do offer trials whereby we can stand up things very, very quickly, such that you can send securely an export file into a system that we have for you, and we can put that through and export it back out. So you don't actually have to go through a full integration process to test the data coming in, to work with your strategy and your rules to work out where those cutoff points need to be and the decisions need to be made. But I think open banking itself, I would just consider how you're going to implement it, what you want off the back of it. And also, like I say, we have that manual journey in too, because you need to consider that not everybody is going to be comfortable consenting to share this data in the first instance.
Okay, Colin, do you have anything to add in terms of if lenders are exploring such a solution, what kind of questions or precise bits of information it would be wise for them to look for?
Yeah, look, I think Kristina summarised it well there. You know, it is, you know, the level of integration required. The platform that we present to Aryza covered, there's kind of minimal integration required. Now, we do have API feeds if someone wants to go and completely integrate, but, you know, there is secure import and export, and that's key. And then the speeds at which we can kind of get the platform in place. That's another key thing to ask yourself. Corona isn't hanging around until we get our houses in order. It's here, it's now. You know, we see on a daily basis increase in numbers, and you know, we can see lockdowns looming. So I think the speed of getting a platform up and running is something that should be kind of a key kind of decision piece for anyone considering it. And again, we've managed, you know, on average, we've managed to get people up and running within kind of 4 to 6 weeks. You know, and that's kind of from a standing start. So they're key pieces to consider.
Yeah, I think we ran an open banking survey with Experian actually early this year, and we've seen timescales like the one you mentioned, actually 4 to 6 weeks. It does feel like in the last 5 to 6 months that lenders have acted at such speed. Well, I hate to use that word, unprecedented. We're guilty of using it too much in the media, but it feels like the agility piece has come through in the last 2 or 3 months, I think, across this industry. And you can imagine it will carry on because of the extensions of these support measures too. So I think we are just about ready to wrap up there. But thanks very much to Kristina and to Colin. Any questions that we didn't get around to, we'll send those across to you guys so you can answer them directly. So our next session will be a presentation from the Money and Pensions Advice Service. This will look at new technology that makes it easier for creditors to refer customers to debt advice. And that's coming up in just a few moments.